Welcome to Lane Turo University. My name is Conrad Lane. If you're interested in reducing your tax bill to zero in a legal and ethical fashion, we do not endorse tax fraud. Please follow the law, pay your due bills, but why not learn how to dance with the tax code in such a fashionable way where you can actually bring your taxable income down significantly or pay $0 for your taxes? It is possible. I'm going to share the Holy Grail, which is 4 different tax codes. We're going to go in deep or deeper on how to actually utilize this. Always fact check anyone you listen to on social media, YouTube, Instagram, Twitter, X, etc. Make sure to fact check. I left articles below so you can actually do your own due diligence, talk to your CPA, your tax person, do your own research, etc. Highly recommend that. Anyways, let's dive right into it. So my name's Conrad Lane. I'm a fellow tour host just like you. If you're thinking about becoming a tour host, welcome to the family. If you're already a tour host, pleasure to be here, and let's dive right into it. I don't care if you have 1 car, 10 cars, 20, 30, 40, 50, doesn't matter. The more cars you have, the more powerful it is because the more compounded it gets, and depending on how you want to mix it up. And there are rules to this. So first and foremost, there's four different tax codes that will benefit and possibly help bringing your taxable income down to zero so that you only pay $0 in taxes or you pay very little in taxes. IRS tax code 162, IRS tax code 179, IRS tax code 167, and IRS tax code 482. So what this means to you as a Turo host, always understand that when you add your car to the Turo platform and you rent it out, and this is also for independent rental car owners, you can follow along. This is the same bones, the same strategy. Even if you rent cars independently, I rent my cars independently and I rent them through Turo. So if you rent them on Turo or independently outside of Turo, this tax strategy works for you, but run it by your CPA or tax person and do your own due diligence and learn the tax code. This is how it works. So when you add your car on a Turo platform, or if it's independent rental, IRS tax code 162, as long as it's ordinary and necessary in the pursuit of income in your industry, for example, registrations, car washes, detail, tire rotations, deductibles, Turo fees, car insurance, Turo protection plans, deductibles, internet, website, business cards, anything of that sort, you actually you can get back as a tax deduction. And the more expenses you have, you can actually bring down your taxable income. That way you pay $0 or pay a lot less taxes than you would without the expenses. That's the first one. But it gets really nice because IRS tax code 167 allows you to actually be able to depreciate your vehicle. And remember, cars are typically seen as depreciating assets anyway. The difference with Turo, or if you have an independent rental car business, it's the only time you typically can turn a depreciating asset into an appreciating asset, because now you're earning income with this appreciating asset while also getting depreciating benefits. Meaning, as soon as you drive the car off the lot, typically it's already depreciated. On your tax bill, that's a good thing. The more depreciation you have and everything doesn't diminish the value of what the income you can bring to yourself, but the value of the car is depreciated. You can utilize that on your tax bill to bring your income down. So now that actually cancels out some of the income you have to bring it that closer to zero. The goal is to bring it as far close to zero as possible. If you're at 100,000, try to bring it down as close to zero as possible. Your expenses, depreciating the car or the multiple cars you have in such a way, that's the one way you do IRS tax code 167. You can also accelerate it in 1 year. The trick to this, though, to accelerate it 1 year, meaning that you want the car to be taxable, tax deduction for that same year. First, it must be over 50%, more than 50% business usage to be able to utilize the car's value and depreciate it. If it's over, if it's over 6,000 pounds, you typically could depreciate the whole cost, the entire cost in its entirety. If it's under 6,000, there's different ways to go about that. But the first one, you can depreciate a good amount off of the vehicle if it's for under 6,000 pounds, and then you can actually carry forward the rest going forward. That's with one vehicle. Maybe you have 4 vehicles and you compound it in 1 year. So say you have multiple vehicles, the more vehicles you have, the more it actually benefits you. I know it gets kind of tricky and it's quite a bit, and I'm not your CPA. I'm not giving you advice. I'm not telling you to do this. I'm just sharing a strategy that I've utilized and a strategy that other tourists have utilized, and it's super beneficial. What essentially happens is that your car becomes a depreciating asset because it's already a depreciating asset, and you're utilizing depreciation and having it accelerated in 1 year with IRS tax code 179. You don't have to utilize IRS tax code 179 unless you want to. If it's over 6,000 pounds, you get it right away. If it's under 6,000 pounds, there's something called a luxury auto cap, where you're capped by the IRS, and that way you don't take advantage of it. It's still powerful though, and the more usage that you have in the car, if they're all 100%, for example, or over 50%, the more it compounds. Then also, even if you can't write it all off first year, like the 6,000 pound vehicle, and I'm sure you probably heard a lot of different, it's been very popular where people buy like G-Wagons, 6,000 pound vehicles, jets, to be able to write off their income. But it only makes sense in certain circumstances. What are you going to do? Keep on buying tanks, keep on buying Hummers, keep on buying G-Wagons? It comes a time where now you're just spending money just to get a deduction. Why not just keep the money in your pocket? The difference with Turo is that the car becomes an appreciating asset because the car you're purchasing isn't sitting there like a G-Wagon or 2 G-Wagons, 3 G-Wagons. It's sitting there and making you money because it's being rented. So now it's becoming an appreciating asset, performing, and while at the same time, you're able to capitalize off the IRS tax of 167. And even if it's under 6,000 pounds and you might not be able to write off the full entire value of the car, you can always carry forward. And also you can implement bonus depreciation. To implement bonus depreciation, the vehicle must be in service that same year. If the vehicle is not put in service that same year, you cannot utilize bonus depreciation. Just want to make that very clear. There's a lot of rules here, and you might hear people on YouTube and social media saying do this, do that, without understanding the rules. And again, I'm not giving you advice. I left all the descriptions below so you can educate yourself, run it by your CPA. A lot of CPAs aren't aware of some of these either. I've corrected some, and they're like, wow, thank you. And I really do mean that. I'm not just exaggerating. There's a lot of laws, a lot of tax codes, and everyone doesn't know all of them. It's a vast majority, and the law gets changed every year. The codes get changed every year. So your CPA might not know this, but show them the articles I left in the description below, bring the IRS tax codes to them, and they'll say, okay, I understand it now. And if they're already aware of it, great. Turo's a fairly new company, so a lot of people aren't aware of it. They've only been in business really about a little over 13 years, and they become popular recently. So a lot of people still aren't aware of these tax advantages with Turo. So forgive them for that, but just make sure you educate yourself. But I digress. IRS Tax Code 167 allows you to depreciate your vehicle. If it's over 6,000 pounds, you typically can write off the full vehicle. There was a time where it was phased out. Right now, you can actually write it off. So that's a pretty cool benefit. That might change because the tax law changes quite a bit. Second, if it's under 6,000, you typically can't write it off the full year. But what you can write off a good amount or even probably majority of it and carry forward the rest of it. That's also beneficial. And then if you, remember, you're still getting a tax benefit, you're still getting a tax deduction, bringing down your income to zero. You also get bonus depreciation, which gives you extra that you can combine with it, where now maybe that could fill out the whole amount that you actually needed. But the car has to be in service that same year, though. So make that very clear. It only works if the car is in business that first service year that you're claiming for, tax year. If, for example, if you buy a car last year and try to claim it for this year, it won't work. If you try to buy a car now and put it in service next year, it won't work because you put in service next year, but you're trying to claim it now. You have to put the car in this, the year that you want to use a tax deduction for. It must be in service that same year to claim it. And it's only for 1 year. So very clear. Just want to make that super clear so you understand. So it must be in service the same year. That's IRS Tax Code 167. It allows you to get that appreciation, that deduction that same year, first year, like that. And the business usage must be over 50% as well. Just want to make that very clear as well. So you don't want to suffer from recapture, meaning that if it's under 50% and you do get paid, that the IRS can recapture and say you owe them for that. So you must prove that the business usage is over 50%, and after that, you're pretty golden. For me, I rent my cars 100%, and so I never had to deal with that. So the goal is, if you rent cars, just make sure you document how long and how many days, and if it's 100% or not. If it's over 50%, how it's the percentages. Also, if you can, try to leave under 100%, but definitely over 50% to capitalize on these extra tax benefits so you can bring your income down to zero. So anyways, let's go into the next one. So IRS Tax Code 482. This is the glue of everything. This is the beautiful, you want to remember that. IRS Tax Code 482. It's for intercompany transactions. What that term is deemed by the IRS, what it simply means is that you're able to benefit in such a manner with related parties, related entities. What this means essentially is, me, Conrad Lane, I can actually have a family member, a sibling, a father, mother, grandmother. If you have children, if you have grandchildren, related family and kin, you can actually have them operate for you. For example, instead of paying someone to clean your cars for you, you can actually pay your relative to clean your car for you and still get the same tax deduction. Typically, you can't do this unless it's two different entities, two different social security numbers, different EINs. It could be a parent company. You could own the LLC over there, but you can't, but it must be different. You must be a sole proprietor, they must be LLC, or it must be two different LLCs. It needs to be different transactable entities that are transacting with each other, but under the same control. For IRS Tax Code 482 is so unique, it's not talked about enough. It's utilized all the time in wealthy circles. That's how you pay your own kid. That's how you, if you have a child, you want to maybe teach them how to teach them accounting, or teach them how to run a business, or clean a car for you. That could be their chore money. You could pay them chore money and get it back in that way. And that's a whole other set of rules. I don't want to even get confused. I don't want to confuse it. But the point is that you could pay your own family to do business for you. And if you don't have a lot of family, or if you don't have family, or you don't have someone that you want to work with in your family, you can also set up an LLC. You can start your own cleaning company, for example, or your own valet company. You could deliver the car to someone as on behalf of the LLC, and charge yourself a fee to keep the money in your own pocket, essentially. That's how you double dip legally, but then also utilize it as a charge to bring down your income further, because it's actually an expense. But you have to document it. It has to be ethical. It has to be reasonable. You must do a few quotes so it's not exaggerated or inflated fees. It has to be reasonable. So I would say go on Google or go online and find at least minimum 5 maybe different valet companies and what they charge in your radius. And based off of that way, and keep the proof, so that if you're ever audited, it can happen. If you're audited, even though it's fairly rare, you have proof showing, no, it was reasonable. It wasn't, you didn't over exceed or overreach. This is the price for your territory. For example, maybe you're in California and maybe to deliver a car is $300, but if you're in Wisconsin, maybe it's $50. Just giving an example doesn't mean that's accurate. Just giving an example. You must match your territory. So make sure it's your territory. But so the point is, you can deliver your car yourself and start your own valet company, or start your own cleaning company if you have to clean your cars anyway, and you're a solo host, or even if you run an entity or a business where you have employees. Now the same fee you're paying your employees, or the same fee you're paying yourself, you're being paid for your time with IRS Tax Code 482. It's a lot more complex than that. Please read the articles I left in the description below and educate yourself, or talk to your CPA. It's a lot more complex than that. But the point is, for IRS Tax Code 482, it allows you to be paid for your own time now. Like this, maybe you want to deliver cars to get more income. Maybe you're delivering to an airport, delivering to a hotel for your tour renter. It's common. Most people don't capitalize on that. It's just a loss. You make money for the delivery if you do charge for deliveries. And if you don't charge for deliveries, this is one way you can at least get something back, pay yourself for what it would cost for someone else to drive the car, and drive it yourself under your LLC or your other entity, or have your wife do it. It could be your wife's. Maybe you're too busy to do this and your wife is the manager of it. You can pay her a management fee. You can pay yourself a management fee, but through the LLC, etc. Your LLC could hold your Turo account, and you could be the person that's actually the person that's maybe operating the business. There's so many different strategies you can utilize in this. And that's the cool thing about Turo, is that it opens you up to wealthy strategies that you can actually bring your taxable bill down to zero, or significant to the point where you reduce your tax bill. We keep more money in your pocket and brings you down a few brackets. The more money you make, the higher your brackets go. And for example, say you could write off, say we have a $20,000 deduction and you earned $100,000. Instead of being taxed at $100,000, you're being taxed at $80,000. And we have more expenses, like, hey, say you're doing deliveries, right? Those are your expenses. Maybe most tour hosts don't capitalize for that. They just deliver the car, especially if they don't make any money. For some tour hosts offer free deliveries, and some charge for deliveries. Doesn't matter if you charge or don't charge. The reality is that if you're delivering a car, that could be your valet business. You set up an LLC, or it could be your buddy, it could be your wife. If you guys are working together, it doesn't matter. As long as it's another entity, preferably an LLC, you could do it yourself and pay yourself in such a way, as long as it's ethical, as long as you document it and it's reasonable. Make sure the prices match the territory. And now you're stacking up different expenses because you're being paid for your time now. Very important too. You can pay management fees to manage your own business, etc. Because maybe your LLC holds it, but you're the manager. You're managing as a sole proprietor, or you have another LLC managing it. That's what the power of IRS Tax Code 482. And again, read the descriptions below for IRS Tax Code 162, IRS Tax Code 167, IRS Tax Code 179, and IRS Tax Code 482. Beautiful tax code. I call it the Holy Four, the Holy Grail. And also another tidbit, another extra piece I want to give y'all. When you actually are on Turo, understand as well. The average price for homes, for example, is anywhere from $200,000, depending on where you're at, to about $1.5 to $2 million. And these houses on average rent for $1,600 to about $3,000. That's pretty much the range on average. There's so many different areas and different price points. That's the average. So understand this. You can get a car, for those that are experienced Turos, you know this is true. And for those that are new thinking about the business, you can actually add a car that's a few years old, worth maybe $7,000 to $10,000, and earn anywhere from $1,600 to $3,000 with that car. Lower barrier to entry, less credit that's needed, less down payment that's needed. You have a car that's worth maybe $7,000 to $10,000, competing with a house that costs at minimum $200,000 or more, earning the same amount. Remember, owning real estate is wonderful and beautiful, and you get great tax benefits out of it, and it's considered an appreciated asset for the most part. Cars are even better in my personal opinion because it's lower barrier to entry, easier to get cars, you get more cars, and a matter of fact, since they are already depreciating assets, the IRS doesn't really scrutinize it as much because it's already understood that cars are depreciating assets. So it's hard to prove that a house is depreciating. However, that's where you have to start getting cost segregation studies and all this. When you have just cars, it's so easy because people understand it's a depreciating asset. So this is the one time when if you actually rent your cars out independently, or if you rent it through the Turo platform, the same strategy works for independent people like myself. I rent cars independently to movie studios and individuals and people, business people that are traveling to the city. And I also rent out through Turo. The cool thing about this is when you rent like that, you actually have a tracker. You're accruing more mileage. The car's depreciating. It's getting older. It's being used more, and it just depreciates by itself because of the nature of a vehicle. You're able to put down your tax bill and bring your income closer to zero. That's the beauty of this. And the more cars you have, the more you can compound it. You can even start having other entities. Say one LLC has 4 cars, another LLC has 4 cars. You don't have to just have one LLC. You can have multiple LLCs as long as it benefits you, and have them holding different cars, different functions, different management. Have a valet coming over here, and you start really bringing that baby down to zero. That's how you do it, people. And remember, the tax of the amount people make for houses, which is beautiful, through Airbnb or even standalone independent rental, arbitrage, or even through like renting out a property that they own, like a single family home or a house in general or condo, is anywhere from $1,600 to $3,000. You can make that with a car that costs $7,000 to $10,000, and you can make $1,600 to $3,000 with the same amount. That's the beauty of this, is that you don't need to spend a lot of money on the car to make the same amount as someone with a home, but you get way more tax benefits and less scrutiny. Anyways, welcome to the channel. Welcome to Lane Turo University, where you learn tax strategies. Let's become a power host. Let's get that 6 figures and 7 figures. Ciao.